All right, strategy four. Someone asked me yesterday at the lunch, what's the biggest change we think happened in the tax law? And by far, a close second would be the 21% C Corp rate, but the biggest deal is this Section 199A. And if you have a pass-through company, there is a chance you are eligible for up to 20% exclusion of taxable income of your K1, which basically takes your tax rate and multiplies it by 80% if you get all of it. So this is a good deal. First of all, if you are below 315, if you're married, filing joint, and your whole personal taxable income for 2018 is 315 for less, everybody gets it, no matter what your profession is. Greater than 315, it must be an allowable business, what they call not an SSTB, and you must have enough payroll. But below 315, you get it all. So some strategy is, if you're not an allowable business, do an advanced retirement plan or shift income elsewhere, and so you can get below the limit and get that deduction. So here's an example. Someone with $500,000 of taxable income. They've got a $100,000 W-2. Their K1 is $440,000, and they get some itemized deductions of $40,000 and plenty of wages. The way this would work is you take your K1, which is $440,000, multiplied by 20%, and this is $88,000 that they will not get taxed on under the new rules. And they'd be in the 35% bracket, but really, they're going to be in a 28% effective rate. By the way, this all would have gotten hit at basically under the old rules at 42-point-something% last year. In 2017, because of the high tax rate, 39.6, and itemized deductions and personal exemptions were phased out. So that is a 14% swing, 14 points, on their K1 2018 versus 2017. So this is a good deal. Where it's not a good deal is if you are a specified service business, health, law, medicine, consulting, actuarial, accounting, performing arts, etc. These are no good. They've issued some proposed regs that just went final last week and gave clarity on this. A couple things to point out. Labs and research, medical research, do qualify. They're not excluded. With law, they lawyers and paralegals and all that stuff are covered, but they somehow put a note in there that printing for law is excluded. Where there's a lot of room for judgment or maybe creative planning opportunities is on the consulting side. There are a lot of folks that it's kind of the in vogue thing to call yourself a consultant, and now you want to kind of look at not being a consultant and seeing if you can qualify. And we have looked at some clients and looked at what the codes they were under and realized that enough of their revenue was actually not consulting related at all. They were just giving some advice with the delivery of another product or service. So if you're able to get out of the consulting code legally and be able to defend it, then that can save you a whole pile of money. They specifically mentioned in there, if you're in education and training, that is not considered consulting. That was specifically identified. So anyway, that's a very important thing to look at, and those that are in, kind of on the line there, consulting, giving advice, not giving advice, or if they're simply giving advice while delivering another product or service, where you can get out of that and take this deduction. So that's a big deal. It mentions in there that financial advisors and financial planners, things that held out there, do not qualify. They're a SSTB, meaning they do not get it. However, insurance brokers do. Real estate came through in great shape, which I guess is no surprise considering the guy that signed the bill. But real estate in most cases are going to get 199A, because there was a question, hey, does rental real estate rise to the level of a trade or business? So here's kind of the rules with real estate. Number one, REITs of all form, no matter how much involvement you have or didn't have, get the 199A deduction. That was a huge surprise, and that was actually in the original bill. The second thing is they created a safe harbor in these final regs that says if you've got at least 250 hours in that activity, you actually get a safe harbor and automatically get the 199A. A couple of wrinkles that you may have to aggregate activities. Any of you that are real estate professionals may have done this in the past, or hopefully your CPA did, to rise to that. They did point out that triple net leases, no matter how big or how much you worked on them, don't qualify for this safe harbor. So there's some risk on triple net leases. It doesn't mean you don't get it, you just don't get the safe harbor. Safe harbors is one of those rare things in the code where it sort of makes it audit proof. It's very rare. Like the home office has a safe harbor. If you take the standard $1,500 deduction, it's audit proof. So they actually gave us one in here, and these are rare. So the real estate investors, for the most part, come out in pretty good shape. They gave you a safe harbor. Just triple net leases could be an issue. So if you are in one of these industries with bad lobbyists and you get above 315, they start to phase out your entire 199A, not just the stuff above 315, but from $0. So what that means is it creates actually a 47.25% tax rate on every earned between 315 and 415. Okay, one final thing for the businesses that are allowed, if you are over, you got to have sufficient wages. So I'm going to show you a quick example where someone didn't have enough wages and don't get the full deduction. So we're using that same example as before. Let's say a service business, and you just have an owner making 100 and another person making 50. Okay, they're a lean machine and using subcontractors. So in this case, they've got a $440,000 K1 just like before, but since they only have 150 grand of wages, 50% of the 150 is 75 grand, so they won't get to exclude the full 88. They'll only get to exclude 75 grand from taxation. So their tax rate comes up a little bit. Instead of 28, it's at 29. So that's the deal there. That's 199A.